What's going on, YouTube? It's TerrenceRe for my weekly video. This video, I'm gonna start with some basics. Get right to what is options trading, and this is gonna be a pretty basic video. I'm gonna talk about, I'm gonna make this real plain for beginners to be able to understand, and we're gonna get right to the basics. I'm gonna go ahead and pull up my Tastyworks platform. What I have right here is an options chain. I am going to go and put it on the Facebook options chain. And so basically options, and I'm just gonna make it easy. You can go to Investopedia and you can Google the actual term, but that doesn't help anyone out. You still need to know how to apply it and make it easy, make it plain, so that just anybody could pick this up and run with it. So options, an options contract is just that. It's a contract, and that contract is based on the stock, right? So what I have, this stock, which is Facebook, I have what you see right here. You see 5 in the middle right here is this. First of all, this is called an options chain, and in the middle you see strike. It says a 5D, 12D, 19D, 26D. That's how many days, right? So this is a 5-day option contract, a 12-day option contract, and etc. That means that this contract expires in 5 days or 12 days or 19 days. So what one would use options for is to either hedge a portfolio, or you can use it to for speculation and trading. So instead of, you can reduce your risk, your overall risk, with options trading. So if I wanted to buy 100 shares of Facebook, what is that gonna cost me to make that transaction? Let's just call it 253 times 100 shares, right? $25,000, 25,300 to be exact. That's what we would spend if we wanted to get 100 shares of Facebook. But let's just say, so if you wanted to get long or go, you wanted to, when I say long, I'm assuming that, I'm not going to assume that everyone knows what that means. Long means you think the stock is going to go up. Short means you think the stock is going to go down. So let's say you think the stock is going up. You could come in here. I clicked on the 47-day option. You say, in the next 47 days, I think that Facebook is going to go up, and I think that it's going to go up. We're just going to buy right here. This is right here, right at 255. Better yet, I'm not going to use a 47-day. I want to make this a little bit easier. Let's go 5 days. This option right here, this contract is going to expire on Friday. So I could come in and I could buy this on August 7th. I could come in and buy this option right here. This option will cost me, it says $530, which is equivalent to $530. So instead of buying 100 shares for $25,000, I could get long Facebook for $530 for the next 5 days. That's reducing your cost basis so that you don't have to buy 100 shares of Facebook. That is one of the benefits. Now, I'm not saying this is called, now when you look at this option chain on the left side, this is calls. On the right side is puts. If you buy the call, you make money if the stock goes up. If you buy the put, you make money if the stock goes down. It's just as simple as that. Now, on this particular video, I'm not going to get into which one is better. This is not a discussion on the particular strategies themselves. This is just to help you guys understand the simple basics of it. Because I see a lot of people do videos. I see videos about what is options trading, but no one goes to a platform to actually open it up and show you what it looks like. So this is what it looks like if you want to buy or sell. You can buy or sell the calls and the puts. If you buy a call, you come right here where it says ask, and you would hit the ask. Once you hit that ask, then that means that was kind of funny. I did say ask. Once you hit the ask button, it's going to alert you, like right here. You see I pressed it. Now right there, it's going to see where it says buying power effect. That lets me know that it's going to take or margin my account $530, right? So that's what if you buy a put. Now this equivalent put is going for $395. You click on that and you see where it says buying power effect, $395. So one of the advantages of options is when you can short the market as well. You can short shares as well. A lot of times a lot of people don't understand. They just buying and holding. You can actually make money when the market goes down if you short shares, but it's very expensive to short something like Facebook. Like it's going to cost you a lot of money to short Facebook. If you were to so I don't even think, like right here, I came up here and hit the bid. Right up here at the top of the screen, you see where it says bid ask. If I hit the bid, that lets the platform know I would like to short Facebook, which means I think it's going to go down. I want to get short. Look at the buying power effect. $12,000 is what it's going to margin my account. So instead of doing that, why not just pay $395 to short Facebook? Those are some of the advantages of why one might want to use options. You don't have to put up as much capital. It is very efficient. It's a very efficient use of capital. Now, you can also, if you remember again, I said buying a put means I think the market's going down and I want the market to go down. Buying a call means I think the market's going to go up. I want the market to go up. I am going to do videos later to let you know what is the downfall for doing that. That's another separate video to go into the particulars of it. Now, you also, along with buying a call or buying a put, you can sell a call or sell a put. If you wanted to sell a call, you would hit the bid, right? So this is hit the ask, meaning I want to buy. I hit the bid, meaning I want to sell. Now, if you sell a call, why would you want to sell a call? Selling a call, if you buy a call, that means you think it's going to go up. If you sell a call, that means you think it's going to go down. Generally, you see right here in the middle. Now, this is Tastyworks. This is, as far as I know, this is only on Tastyworks platform. I don't know if it is on any other platform. Maybe somebody can chime in the comments and let me know. I don't know if E-Trade has something like that, or, I don't know what else, I know Tastyworks and Thinkorswim. So right here, you see this ruler, this orange ruler right here. That orange ruler in the center, this is the expected move. So what options will show you is to get this expected move number, it is a math equation that has something to do with the implied volatility of Facebook. And so they use the IV and they use a math problem. You don't have to know why. If you want to know why, you can go to Tasty Trade, and I think they have the math equation on there that they use to solve for the expected move. But it basically is telling me in the next 5 days, Facebook is expected to move a plus or minus $7.85, right? So that means that's what this is. This is from where it's at right here now. It could go up $7, or let's just call it $8. It can go up $8 or down $8. So one of the things that you would do as a seller of an option is you could sell the expected move. This is one of the things that a lot of option traders do, and they call it selling premium. If you buy an option, you are a buyer of premium. If you sell an option, you are a seller of premium. The easiest example that I can use to help you to understand what that means is, think about insurance. You gotta you literally buy. What do you do when you buy your car insurance? You get a bill and you pay your premium, right? Like you pay it for the year or 6 months or whatever you pay for, but you pay for that insurance, right? And you're covered for a certain period of time. That is similar to an options contract. If I buy any one of these options over here, I have a certain period of time that I'm covered to get that movement that I need in that particular stock. When you sell an option, you are taking the place of the insurance company. Like the insurance company will sell and collect premium. They're collecting premium. So this is what you would call a high probability trade. When you sell out of the money options. If I came out of the money and sold out of the money, meaning at the money is right here around where the actual price is of the option, in the money would be on the call side would be right up here, and vice versa on the put side, right? It would be down here. And then out of the money would be out here. This is out of the money. So this dotted blue line is one standard deviation, which is about 68%, which means that most of the pricing or most of the movement of these options occur within these two dotted lines, which would be 68% of the time, which is one standard deviation. So what a lot of option sellers like to do is come out of the money and then sell this call. And then I could come over here. I could come and sell a one standard deviation call and a one standard deviation put in Facebook. And look, that green right there lets you know my money's on. I need the stock to stay inside of here. Look at my probability of profit. The pop, 82%. I have an 82% chance of profiting on this particular trade. I have a 91% chance of making 50% or better on this trade. So meaning I'm taking in 204, which is $204 premium. So all I need for within the next 5 days is for the stock to stay here. If I buy it back and only look to collect a buck, then I got a 91% chance of doing that. That's the game of options trading. Now you don't have to. I know if you don't understand this and you're a beginner, don't try to wrap your mind around all of this right now. I will subscribe and stick with me. Every week I will get further and further and further into what's going on with options, and I'll talk more individually about calls and puts, and then I may even do some videos to plug in some live trades so that you understand. But what a lot of times what people would like to do is say, hey, I think just to keep it simple, you think Facebook going up, and this week, if you think Facebook is going to continue to go up, we look at this chart. This is Facebook. It gapped up. This is where it's at right now. Let me bring that down some so we can look at it. That's where Facebook is right now. Do you think it's going to go up for here or down in 5 days? If you thought it was going up, you could come right here and buy a call. And you say, well, what's the difference and how do I know which call? What most option traders use is a delta. Right here is your delta. A delta is a Greek. That's where I'm going to leave with that. And then I'll pick up on my next video about deltas. But that's how you choose which delta you want. And basically, a easy way to understand delta is if you buy this delta right here, this 53 delta, what that generally means is for every dollar of movement in the stock, you will make 53 cents. For the most part, that will change as the stock moves and as it either gains appreciation or loses appreciation. But generally, you will make 53. If you wanted to get a dollar for dollar, you will come up and go further in the money, and it gets more expensive. But you're still not going to get anywhere near $25,000 that you were paying if you just bought 100 shares, right? So you could get long this stock. If you wanted to get short, see, you wanted to make money. You say, I think it's going down. I don't want to just buy shares. I want to make money if the market goes down. This week, I think Facebook's going down. You could come over here and buy a put, right? Now, I will talk about the downfalls of buying and versus selling in another video. But basically, this is what options is. You have a contract with options. That's it. People try to make it more. They try to make it more confusing than what it is. But all it is you have a contract with options on it, and the contract, and you have basically meaning you can do a lot of different things besides just buying and holding stock. There's nothing wrong with buying and holding stock if that's what you want to do. Right now, the market that we in is working, but back when the coronavirus first hit, you seen the market cratering and tanking, you just sitting there losing money. You don't have to do that. You can sell options against your long portfolio, which means, like, let's say I owned 100 shares of Facebook. I could sell a call against that. That's called a covered call. And I will get into that, meaning like you write an option. You may hear another terminology that someone will use. They will say write an option. That just means they're selling an option, and you may hear someone else say sell premium, but that's all that it means. So basically, you got calls, you got puts. You can buy a call, you can buy a put, or you can sell a call and sell a put. If you buy the call, you want the stock to go up. If you buy the put, you want the stock to go down. If you want to sell the call, you can still want the stock to go down and sell the call. You can sell the put and want the stock to go up. The only difference is you make more money if you buy it. There's no cap on your money. It can keep going up or keep going down, and you just keep making money. You only lose what you pay for the option. When you sell an option, your money is capped, but you have a higher probability of profit. And then I will get more into that on the next video. But what I just wanted you guys to get is what is an option. And so now that you know, you can get on an option chain and look at the options, right? And then I'll get a little bit more deeper into it in another video. So you like this video? I'm going to continue to make, easy videos for you guys to understand, not just options, stocks. I'm going to do some futures videos, and I will be primarily, when I'm dealing with just the trading part, I'll be on Tastyworks. I'm going to put a link down in the description where you can sign up for a Tastyworks account. Tastyworks right now is offering specials where they're giving away free shares if you sign up and open a brokerage account with them. Also down in the bottom, I just signed up with a network marketing group on buying Ethereum. That thing is smart contracts. I'm going to put a link into that down in the description. Also down in the description, you're going to see a link to Melaleuca. When the coronavirus first hit, there was a shortage on hand sanitizer, cleaning supplies, things like that. I never experienced that because I order my products online through Melaleuca. Check it out. I get my soap from there. They have a soap that's called the Gold Bar. I love the soap. I'm telling you, it's dope. I'm telling you, it's crazy. You'll love you try hit the link, go there and order you some of the gold soap. You'll like the soap. I order a lot of other products from there too. You can get those products and you can make a little money off of things that you buy at the grocery store anyway. So look out for that link in the description. And if you like the video, hit the like button, please. Subscribe, share, comment in the comment section, and then let me know what you want to what do you want to know, what don't you understand. I promise you I'll come back harder with another video to help you guys out. Thank you. I appreciate all of your time and all of your support. Peace.